Hello, Dr. Tim Creel here. Just wanted to talk a little bit about Chapter 12 in auditing. Okay, so Chapter 12 looks at reporting. The reporting, or it's related to different aspects of reporting that's required of the external auditor. So the main thing that the auditor is going to report on is the audit report. And this is where they give their conclusions about the audit. What they found. Do the financial statements agree with US GAAP? Uh, are the uh, are the internal controls effective? So reports on both the effectiveness of internal controls and the financial statements. The sections of the standard report would be the opinion. This is the auditor's opinion on the financial statements and the system of internal control. The basis for the opinion, responsibilities of management. Basically, remember, management is responsible for the financial statements. The auditor's responsibility is to do the audit, and to do the audit according to standard practices in the industry. The integrated report. This is mainly what you see, is going to report on both the financial statements and the system of internal controls. You could do separate reports. Do the financial statements agree with US GAAP? Is the system of internal controls effective? But typically they do them integrated as one. Why do two when you can do one? The types of opinion. Unmodified. Unmodified is basically what companies want. Unmodified means that the financial statements follow GAAP and the system of internal controls is effective. Now, a qualified would only be related to the financial statement audit. What a qualified opinion is it's everything is good, everything follows GAAP except for. Qualified is sometimes it used to be called sometimes an except for opinion. Everything is good except for this. An adverse could apply to both financial statements and system of internal controls. An adverse would mean that the financial statements taken on the whole do not follow GAAP. The system of internal controls is not effective. Adverse just means that it's pretty bad. Um, and disclaimer of opinion just means that a disclaimer of opinion could be either imposed by the client or it could be imposed by the auditor. And a disclaimer of opinion just means that the auditor cannot gather enough evidence to come up with a conclusion, to basically have an opinion. And it could be the auditor. What if the auditor gets to the end and discovers they're not independent? They cannot give an opinion. Or it could be the client. And it could be something that the client did purposely. What if the client will not let you confirm balances with some customers? If it's material, then you couldn't give an opinion. Um, or what if there was a fire that destroyed a lot of the records and the auditor just says, we just don't have enough records to verify what needs to be verified, and they would disclaim an opinion. Just kind of some general reasons when this would occur. Most of the time, you're going to see an unmodified opinion, which is, I think, about 98, 99% of all cases, you're going to see an unmodified opinion. And the thing is, that's what companies want. Companies do not want I guess, kind of a black cloud hanging over them. And that would be, qualified or, they don't want anything but an unmodified opinion. So companies will work towards that unmodified opinion. And if the auditor says things need to be changed, the company will typically follow along with it and make the necessary corrections because they know that they've got to do that to get an unmodified opinion. Like I said, their stock price would be hurt. If you're a CFO and you want to be fired, get anything beside an unmodified opinion, and you might be fired. Uh, Easiest way for a CFO to lose their job. So, very much the goal for companies is we want an unmodified opinion. Now, modifications to the auditor's standard report, a departure from GAAP. If the departure from GAAP is not material, an unmodified opinion would be fine. If everything was good except for, maybe a certain area or so, you could give an unmodified opinion. If it's material in certain areas but not pervasive, you could give a qualified and except for opinion. Everything follows GAAP except for this. If it's material and pervasive, then typically the auditor would give an adverse opinion. The title of the opinion is at the top of each audit report. Notice the different verbiage based on the opinion. Go through the chapter and read some of these different types of reports and notice the difference in the verbiage with the opinions. The auditor must give the reason for the opinion, especially if they're doing an adverse opinion or a qualified opinion. They're going to give the reason why. Now, if they're given an unmodified opinion, they're just going to say that we've audited and we find the financial statements to follow US GAAP and to properly represent what they represent, follow US GAAP, and that the statement or basically the system of internal controls is effective. They're going to state that in the opinion. But especially, like I said, a qualified or adverse, they're going to state why. Or if they have to do a disclaimer of opinion, they're going to state why. Now, a scope limitation. This goes along with the disclaimer of opinion a lot of times. A scope limitation, client imposed or circumcised or circumstance opposed. Now, if it's client imposed, what that means is that the client is prohibiting you from doing certain things that you need to verify. They're not going to let you talk to certain customers, or they're doing something of that nature. And you would really have to think twice about the audit if the client is imposing things like that on you, if they're giving you the scope limitation. Or circumstance imposed, that would be more of what we were talking about a little while ago. What if there was a fire and it burned most of the records and the backups failed and things of that nature? Then that would be, yes, caused by the client, but it would be more related to the circumstance and not anything that the client has done. If scope limitation is immaterial, unmodified opinion. If material, no alternative procedures and pervasive, a disclaimer of opinion. Like, think about it this way: if the client does not want you to contact certain customers to confirm balances, if you could verify it under our alternative procedures, then you could use alternative procedures. But if no alternative procedures are available, you'd have to give a disclaimer of opinion. If material but no alternative procedures available, unmodified. Okay. Again, notice the verbiage in some of these opinions. And I've got here, notice it in the disclaimer of opinion. You would have to state why. And I think that should be adverse there. I think that if material but no other alternative procedures available, you would have to do it. That would be adverse. That should not be unmodified there. That's my fault. A problem in the slide. I'll update that before I put it into the course. Okay. So group financial statements. This would be something like consolidated financial statements. When you get into advanced accounting, you learn that if one company owns more than 50% of a subsidiary, they have to do consolidated financial statements. And so group financial statements are something that normally you end up auditing a lot of times, especially if you're auditing very large companies. Now, there could be component auditors. Another auditor performs the audit for one part of the consolidated financials. This is pretty common if you've got a company that's in the US, but maybe they have a subsidiary in Europe. If you're using one of the big four audit firms, they have a lot of offices outside all over the world. If you're using a lot of times a regional auditor or even one of the national audit firms like BDO Seidman, for example, um, they might have European operations, but they might not. And so in that case, they might have to partner with an audit firm in Europe to do that part of the audit. And so whenever that occurs, there's kind of a division of responsibility. And there's different approaches the auditor can take to that. If they take responsibility for work of the component auditor, they can give an unmodified opinion. So if the component auditor says everything's fine over here, the audit firm decides to take responsibility for that, they just give an unmodified opinion. If take no responsibility for the component auditors and refer to them by name, they would obtain permission and present the component auditor's report. If don't take responsibility and do not refer to them by name, they would indicate division of responsibility within the unmodified opinion. So within their audit report, they would indicate the division of responsibility. Other matters encountered during an audit. An emphasis of the matter. Provide information fundamental to the financial statements user's understanding. Like if there was a departure from GAAP, they might do an emphasis of the matter to explain why it was acceptable or why it was, it didn't change the audit opinion. That's just one example. There could be a lot of other. Sometimes it's just the auditor, something strange has happened and the auditor just wants to emphasize that occurrence or emphasize that event. Maybe there was a very large event, like possibly there was a very large event that affected something with the company, and they'll do an emphasis of matter on it. It's kind of an explanatory paragraph, something to do with the financial statements of the client. Now, an other matter paragraph, a paragraph which adds to the user's understanding of the audit team's responsibility or auditor's reports. This would be related to what the auditor is doing or something with the audit. This would be like if they were, we talked about in the last slide having a component auditor. This would be where that would be, that could be reflected here, depending on whether they accepted responsibility for that component auditor or not, like we talked about in the last slide. And then consistency, part of it also is a comparison of an entity's financial statements over a period of time. So an emphasis of matter paragraph could occur for changes in accounting principle or changes in the form of the reporting entity. Also, a change to a GAAP preferred method. So, this would be a lot of things here that could basically hurt consistency or could be considered inconsistent changes, over, from one year to the next would be probably reported on an emphasis of a matter paragraph by the auditor. A going concern would be reported within the audit report. This is where, again, we talked about it some in the last chapter, that this is where the auditor is unsure, the auditor has a strong feeling that this company will not make it through the following business year, that they're going to go out of business. That they have concerns due to the financial condition or the worsening financial condition. And so they'll issue a going concern report. The auditor will, and they'll include it as part of their audit. So a company could get an unmodified opinion that their statements follow GAAP, their internal controls are effective, but they could then get a going concern that business conditions are such that we have doubts that they'll be in business this time next year. Other information accompanying audited financial statements, the management's discussion and analysis, which is part of the 10K sent to the SEC every year by a company. They add an additional section entitled Other Information Included in the Annual Report, stating auditor did not express an opinion on this material, and it is the responsibility of management. Sometimes you will see this. An auditor will include that. Requires supplemental information. In this case, this would be information that the client is putting in, maybe could be something they're required to do by the SEC, some type of reporting. The auditors are required to perform limited procedures on it and mention this in an other matter paragraph. Like the company is required to list this due to the nature of the industry they're in. And they would basically mention, the auditor would mention this in an other matter paragraph. Other reporting topics: comparative financial statements, 2 years of balance sheets, and 3 years of income statements, stockholders' equity, and cash flows. Different language in auditors report based on the circumstances. And here's some examples of when you would have different language in an auditor's report. Same auditor, same opinions for comparative years. So this would be pretty standard. Same auditors, different opinions over comparative years. Again, there would be some different verbiage based on this. Same auditors with modifications of previously issued opinion. Again, some different verbiage. And then different auditors in comparative years. What if 3 years ago you had Deloitte Touche, and then the past 2 years you've had Price Waterhouse? Basically there would be different, you would have different auditors in comparative years. And then summary financial statements, these would be financial statements that are more concise and more kind of summarized totals. So the auditor might, if the auditor felt like the summary financial statements did not properly represent the company, they could, require some type of reporting based on summary statements, or include something that they don't feel like the summary statements follow, or present properly the company if they decided to do that. Like if you go out to Yahoo Finance, for example, those are more summary statements. They're more concise. They don't have as much detail with them. They don't have the notes with them. Supplemental information, no audit opinion, but just will express whether it's fairly presented. Again, this is something that could come up within the audit report. And of course, the disclaimer of opinion, this is when the auditor cannot give an opinion. They just were not able to gather the evidence, through fault of the client or circumstance, to give an opinion. And again, it kind of goes back to the term scope limitation that we were looking at earlier. And that is all for the reporting done by the external auditor in Chapter 12. Thank you and have a great day.